My name's Ethan Braid. Today we're going to talk about the dividend for the S&P 500. First, we're going to look at the long-term dividend history for the S&P 500 and the long-term growth rate. Then, we're going to take a look at SPY, the ETF that tracks the S&P 500, and we're going to take a look at what the dividend has done for SPY back to the year 2000. So the last 24 years of dividend history. What has the growth rate been? How has that dividend performed over the last 24 years for SPY? Here's a look at the historical dividend for the S&P 500 and the predecessor index, the composite stock index, all the way back to the year 1900, 123 years of data. What becomes very obvious is that the dividend for the S&P 500 has been remarkably stable over the last century plus and has come under pressure only 3 times: 2008, the Great Depression, and World War I. The long-term growth rate of 5% has easily beaten inflation. In the year 2000, the dividend for the S&P 500 was around $16, and by the end of 2023 had grown to over $70. Outstanding growth over this 24-year period. Now, what I find really interesting is that during the 2000 to 2010 era, where we had 2 recessions, the S&P 500 dividend, or SPY dividend, still grew. It was up by 50% by 2010, and that's even after we had the 2008-2009 drawdown on the dividend. You were still ahead. At the same time, the share price for the S&P 500 or SPY was really taking a beating. Look at the losses in 2001 and again in 2008. Overall, you had no appreciation on price for 13 years. And again, if you think back to the previous slide, by 2010, you were 50% higher on the dividend, but the share prices were much lower than they were 10 years prior. Big difference between share price appreciation and dividend income. Now let's take a look at the compound growth rate of the dividend for SPY over the last 24 years. To calculate the SPY dividend growth rate, we're making a $1 million investment in SPY on January 1 of the year 2000. And then we're going to track the dividend over the next 24 years. In year 1, the year 2000, we received $10,252. The yield back then was very low, 1.15%. And in this illustration, I'm assuming that we're either spending the dividend or reinvesting it somewhere else. We're not reinvesting these dividends in SPY because we want clarity with what the actual growth of the dividend has been on its own. So here we go, starting the year 2000, 10,000 and change, 1.15% yield, and we're growing and growing. And then we hit 2008, and notice we go from 18,528 to 14,829. We take a drop in the dividend. Now let's see how we did from 2010 to 2023. Nice growth in this dividend. And we notice that once we get to the end of this sequence, we're up 4.5 times on the dividend. From where we started at roughly $10,000, we're now at $45,000 a year in dividend. Our principal has grown tremendously. Our ending balance is now $3.2 million, and our dividend growth rate has annualized at 6.37% compounded over this 24-year period. When you look at all this data, what should become very obvious is that dividends have a lot more stability than stock share prices, particularly a growth index like the S&P 500. The first decade of the 2000s really was a wild time. All you have to do is look at this $1 million investment becoming $600,000 by 2008, down almost 40% from where you started many years earlier. Really, really difficult time for people. Although the dividend was growing during that time, which is just amazing. Here's the long-term view for the S&P 500 and what you can expect from SPY. The S&P 500 moves in a very easy to identify pattern. We go from boom to bust, boom, bust, boom. Presently, we're in the boom or bull market phase, but we're probably not too far away from another long-term bear market like the 2000 to 2013 timeframe, or the late 60s to the early 80s. The business cycle is real. And we will transition from this bull market to the next long-term bear market. It's not if, it's when. And as that happens, dividends will once again be very, very important. So keep your head on straight, check your asset allocation, good time to update your risk tolerance, and have a plan for the future. I hope this video got you thinking. I hope it helps you better analyze your finances and overall improve your family's financial plan.